All right, everyone, let's talk about what the media has been saying nonstop. According to mainstream outlets, China's economy is supposedly in free fall. Capital is fleeing, banks are shutting down, and the property market is doomed. But let's get real, China is actually in a stronger position than ever, leading in key sectors like electric vehicles. Beijing recently rolled out a substantial stimulus package to support its economy. And you know the situation is challenging for the West when you see things like the Ford CEO driving a Chinese-made Xiaomi EV for months and not wanting to give it up. Western countries continue to buy and use Chinese products, and it's not just about goods. China's financial influence is expanding fast. Remember, China is the top trading partner for over 120 countries, and with this vast network, they're starting to set payment terms. China's trade with Russia, for example, is nearly fully de-dollarized, with 95% of transactions bypassing the dollar and settled mainly in rubles or yuan. China's share of cross-border transactions has now surpassed 50%, conducted mostly in their own currency, effectively sidestepping the dollar. China is determined to keep pushing this further. By conducting trade in yuan, they gain protection against potential US dollar sanctions. Plus, they have more control over their fiscal policies and can manage deficits or import gaps by printing more RMB if needed. The US weaponized its financial system by freezing Russia's assets and cutting them off from SWIFT, signaling to China that the same tactics could be used against them in a future conflict. That's why China has little choice but to reduce its reliance on the dollar, and major banks worldwide are recognizing this shift. British banking giant HSBC recently joined China's cross-border interbank payment system, citing rising demand for transactions in RMB. With China increasingly trading outside the dollar, HSBC wants to be at the center of this growth. For global banks, working with China is becoming essential. There's simply too much money at stake. Since the early 2000s, China's share of global GDP has surged from 3% to nearly 17%, while economies like the US, EU, Japan, and the UK have seen their shares decline. If you're HSBC, you want to position yourself in markets that are expanding, especially when the West keeps predicting China's downfall. At the Munich Security Conference, Secretary of State Blinken highlighted Washington's strategic competition with China, stressing that nations should choose America over China. But in the international arena, if you're not actively engaged, you're the one being acted upon. Re-engaging multilaterally was essential, and we've accomplished that. Regarding strategic competition, especially with China, a few points stand out. First, we have a responsibility to handle this relationship wisely, a view echoed by many countries. Managing it responsibly is exactly what President Biden is doing. When it comes to other nations, the aim isn't to force them into choosing sides. Instead, it's about offering an appealing option. If we do this effectively, as we have, and will continue to do, I believe the choice will become increasingly clear. Now, HSBC's decision to align with China may come as a surprise to some. By joining China's cross-border interbank payment system, China's alternative to SWIFT, HSBC is acknowledging the importance of China's trade network, especially given Western sanctions' unpredictability. Should Chinese banks be removed from SWIFT, CIPS offers a fallback for transactions, especially with countries in the global south. HSBC's partnership with CIPS means facilitating these transactions and benefiting financially, despite potential sanctions. This move signals a shift, and HSBC won't be the last Western institution to join China's system. BRICS economies led by China are becoming the world's growth engines, and CIPS provides a secure channel for these countries to sustain trade. Banks see an opportunity for substantial profits, as trade must be financed, no matter what. Currently, China's share of global exports is about 14 to 15%, with over half going to developing countries, which will continue to grow. Banks like HSBC find it challenging to exit China due to its dominant economic presence, especially in Asia. Nations like Hong Kong, Vietnam, and Indonesia rely heavily on imports from China, 42%, 33%, and 27% respectively. As trade grows, so does the demand for trade financing. Companies and suppliers require loans, and banks like HSBC are there to provide credit and insurance, often at lucrative interest rates, sometimes reaching double digits. Global finance knows where the growth lies, and China's economy is simply too significant to overlook. In the latest IMF projections for global growth, China, India, Russia, and Brazil have all seen their forecasts raised, with China leading at 21.7% of projected global GDP growth through 2029. The U.S., on the other hand, is forecasted at 11.6%, a decrease from previous projections. These projections speak for themselves. If containment strategies were effective, China wouldn't be leading the growth forecast. Clearly, there are numerous factors contributing to China's continued economic success. China's economic strength draws on a skilled, cost-effective workforce and a dominant position in global supply chains. The West's actions, particularly toward Russia, have indirectly boosted Beijing's growth, making it a major beneficiary in the process. Much of China's success is actually rooted in Western outsourcing, especially in manufacturing. Take Russian natural gas. In 2022, Europe imported about 60 billion cubic meters annually, 4 times China's intake. But in just the first 9 months of this year, China's imports have surpassed those of the EU, and at a substantial discount of 20 to 30%. This cheap energy is vital for both power generation and as a feedstock in petrochemicals, fertilizers, and manufacturing. It's no surprise that major petrochemical firms are shifting operations from Europe to China, where input costs are far lower. BASF, for example, is halting production in Germany, including ammonia and other chemicals, due to Europe's high energy costs. As industries relocate eastward, banks and countries want to be part of this economic shift. Meanwhile, Janet Yellen has been critical of China's economy, despite Beijing's recent major stimulus package involving over $300 billion in bonds and substantial bank liquidity injections. Yellen wants China to increase domestic consumption to reduce the reliance on exports, which are pressuring G7 economies. But China's focus is on stabilizing its real estate sector to prevent further price declines, not a massive consumer spending boost. Additionally, Beijing is holding back further measures until after the U.S. November election, especially given Trump's tough on China rhetoric. Trump has pledged tariffs as a foreign policy tool, which could strain U.S. alliances while targeting China. Currently, Trump's chances in betting markets stand around 65%, and China is preparing for potential impacts. When Trump's tariffs were first imposed, China's exports to the U.S. dropped 25%, although they eventually rebounded. A significant increase in tariffs could push China's exports down again, potentially by half, according to UBS, with only some rerouted through middlemen like Mexico. This workaround could preserve trade volume, but would reduce profits for Chinese exporters. Notably, China's finance minister hinted at a significant stimulus following the November election, signaling that Beijing is prepared to respond based on the election outcome. If the U.S. elects Harris, the response may be more moderate, but if it's Trump, Beijing may unleash a more aggressive fiscal plan. If Trump wins, Beijing will have to go all in on stimulating domestic consumption, launching substantial measures to keep the economy buoyant. This wouldn't be a minor adjustment. They'd go all out with massive stimulus. But this doesn't mean the U.S. or EU would see any benefit. Instead, China's boost would favor its own companies, and Beijing could respond by raising trade barriers to counter G7 economies. With so many products made domestically, Chinese consumers could easily keep spending within their own ecosystem. An overlooked consequence, one that Yellen may not have fully anticipated, is China selling off even more U.S. bonds if tariffs are imposed. China holds roughly $770 billion in U.S. debt, but that amount has been shrinking since 2022, and it's likely to continue dropping as the U.S. distances itself from China. This debt holding is essentially vendor financing, where China has limited its own consumption to lend Americans money to buy its goods. However, if U.S.-China trade collapses under steep tariffs, there's no reason to continue financing those customers, especially if goods won't reach them anyway. Ironically, this could drive up borrowing costs for the U.S. under Trump's tariffs, making it even harder and more costly to bring manufacturing back home. So while Yellen may express frustration, the signs are clear. What do you think? Will more banks start using China's payment system? And will Trump really initiate a trade war with China? Let me know in the comments. Don't forget to like and subscribe, and stay safe as we navigate these turbulent times.